Hello and welcome to Cryptocurrency Trading, how to profit daily using technical analysis by Wealthy Education. What you'll learn in this course, you'll learn how to trade cryptocurrencies profitably using technical analysis. You'll learn the most effective technical indicators to use. You'll also learn how to trade Fibonacci and Fibonacci extensions. You'll learn how to trade chart patterns and breakouts. You'll learn about trading psychology and risk management strategies. And beyond that, you'll be learning with real-world examples. By the time you're done with this course, you'll know exactly what this chart is telling you. So, if you're looking for a course on technical analysis and how to enter the exciting world of cryptocurrency in a profitable manner, come inside and join us. Sign up for this course today. Hello and welcome to the first video in our course, Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to take a look at three very basic tools in the technical analysis world. You should know how to use all of these, and therefore you can set up your charts, because technical analysis at its core is simply marking up a chart with layers of interest, areas that you may want to buy or sell, areas you want to avoid, that type of thing. And using these tools allows you to do just that. I'll be taking a look at levels. I'll be taking a look at trend lines, and I'll be taking a look at channels. So, first of all, I would describe a level as simply a price. It's a level on the axis going horizontally on a chart. You can go to the menu over here, click on the line tool, click on the arrow for the submenu, and go to horizontal line. By doing so, you can then click on the chart and place a line. You can place it wherever you want. You'll notice that the bubble has appeared. So if you hold down the mouse and button and scroll, you can see that the price can be moved back and forth as I am doing here. You can also, for example, right click on this dot and then go to format, and you can change the price manually. So for example, if I want 6,500 even, I just click on that and it'll take it right there. I can also change the style and all of that as well. I can thicken the line as you see behind you. I can change the color as you see behind you as well. And that allows you to customize the charts however you wish. The nice thing, once you click away, you can click on the chart, and then it becomes inactive, and it will activate itself again if you hover over it. If you change time frames, so let's say I want to go to the weekly chart, it stays right where it was. So this is an important way to mark up the chart to give you an idea of important levels down the road that might be on higher time frames, that may be market turning areas, but on the shorter time frame you may not be thinking about. The next markup would be the trend line. Again, go to the line menu, click on the arrow for the submenu, and then click on trend line. Trend lines are similar, but they are diagonal in nature. So you click on the chart, you hold the button down, and you drag right along. Click it again, and then there's the line. Again, you can format it just as you did the horizontal line in color, thickness, that type of thing. So you can see that this is an area where price continues to bounce from. That is an uptrend line. The exact opposite is a downtrend line. So, for example, you could draw it there, and you can say that price has not been able to break above there. So that's the second very important markup that you'll need on these charts. But one thing that I would do before I go on to channels, this is kind of messy here, so let's go ahead and clean it up. Right-click in the chart somewhere away from any of the drawings. Go to Remove, and then remove all drawing tools, and you have a fresh, clean chart again. Now, for channels, you may notice that in a particular part of this chart, we have a channel going, and a channel is simply that uptrend line that I had mentioned previously, but it's got a parallel uptrend line, and you can see that in this area here, you could have bought, sold, etc. And there's an entire theory of trading behind channels, and that's why they're so important. You can do it one of two ways. You can do it using just regular trend lines, or, like that. Or you can use the tool for parallel channels, which will give you a perfect parallel channel, which is really what you're looking for. You can click on the submenu in the line chart for parallel channel. It functions very much like a trend line in the sense that you drag it, and then when you go to close it, you drag it, in this case, up, and you can see that there's a purple area, and of course you can format this just as you can any other drawing. So let's go ahead and make that a little bit lighter color. Maybe something like that would be the lines, and then the middle, you can change that as well. The background, you can just take that out. In this case, I'm going to lighten that up to kind of a salmon color. And you can see that's completely changed. The middle line has appeared because I did that. And that opens up a whole new world of trading possibilities going back and forth between the buying and the selling. These are very important drawing tools to understand in the platform, and it'll give you a leg up on marking up your charts. Again, as I previously mentioned, these do transfer to other time frames. So if there's an area that has been important previously, it could be in the future, and that's what technical analysis is all about. So stick with us. In this next video, we'll talk about support and resistance and the importance of that, as it is the basic fundamentals for all things technical analysis. Hello, and welcome to the second video in cryptocurrency trading, how to profit daily with technical analysis by Wealthy Education. In this video, I'm going to discuss support and resistance. Now, support and resistance, the very first thing that I would say about it is that any technical analysis based system, analysis itself, forecasting, anything along those lines will depend heavily upon support and resistance. If you do not understand this concept, your likelihood of success in the trading world is greatly diminished. So the first thing that we need to discuss is, what exactly is support and resistance? Support and resistance can be thought of as places where the market supports price or resists price from gaining. It is where you have an imbalance of buyers or sellers, and the market simply cannot pass through that area. So, as you see the Ripple chart in front of you, it doesn't take a lot of imagination to notice that somewhere around 31.5 cents, there seems to be buyers coming back into the market. That is support. Market participants are supporting Ripple at this level, this price. Now, resistance is just basically the exact opposite. You can see that price could not break above 32.5 for these couple of days here. That could have been thought of as resistance. A quick word on support and resistance that I would caution you about thinking of them as solid walls of orders or anything like that, because the reality is they aren't. They are simple guidelines. One of the best descriptions of support and resistance I have been able to come up with over the years is thinking along the lines of a gun range. In an outdoor gun range, you have a shooter on one end, and then on the other end, you'll have an earthen mound. And the reason for the earthen mound is to keep the bullets from going through the other side, obviously. But why is it an earthen mound and not a steel plate, for example? A steel plate would cause a ricochet, so they use these earthen mounds. And what does the earthen mound do? It absorbs inertia. The bullets will stop somewhere in this range. And that's pretty much how support resistance works. So, for example, going back to the 31 50 level, 31.5 cents level here on the Ripple chart, you can see that even though that line does match up quite nicely, you can see we did break through slightly, and that is part of that inertia absorbing action that I was talking about. Unfortunately, far too many traders will put a stop loss order or choose to exit the market 1 or 2 ticks below these lines, and they almost always get tagged sooner or later. So because of that, you always want to put a little bit of a distance before you choose to get out. So in this case, perhaps you would choose to get out of the trade at 30.5 cents if you had bought Ripple and it broke down that bit. So you have to think of them more as guidelines. Every once in a while, they will be hard as a rock, but that's less common than an area like this. And a lot of that comes down to fills. You don't always get filled at the exact price. Large institutions don't want to throw all of their money in at one time because they can move the market against themselves. So if you can imagine a huge hedge fund looking to buy Ripple at 31.5, well, what they've been doing is they've been buying it in little bits and pieces every time it gets close to that area. Because if they throw their entire size in, they may shoot the market up several cents, getting filled along the way, making their order much worse. So there's a multitude of reasons to think that support and resistance is more of a zone. Another thing that support and resistance tends to do is show up at intervals that are round numbers. And what I mean by that is, I'll go ahead and go to the daily chart here on Bitcoin. So an obvious support level here is the $6,000 level. A lot of big money wants to buy Bitcoin at 6,000 so far. You'll see that time and time again. A large number will cause resistance or support. See, so that's 10,000. That's a large round number. So it attracts a lot of attention is probably the best way to think of it. So how do you draw support and resistance on one of these charts on TradingView? So let's go ahead and go to the hourly chart again. And if you remember, I had you drawing horizontal lines on the first video where I was talking about marking. And you can do it either a horizontal line or a horizontal ray. A horizontal ray is just a line that starts where you click it. So let's say here. And you can see that you can mark it. And you can see that it goes through from that point on. Let's go ahead and remove that. Typically, you'll see it drawn as a horizontal line, though. So again, let's draw that horizontal line. Let's look at 6,560. And you can see that this is an area that has offered support and resistance. And you will quite often see that. That's another thing about support and resistance you should probably be aware of. There's something called market memory. And the reason for that is that you have all of these sellers in this area time and time again. Eventually, they get blown out. So now you have a lot of people who have been shorting Bitcoin at 6,560. It goes underneath. They get blown out again. Well, the participants that were losing money now have no interest in losing any more. So one price comes back down so that they can get out at either break even or, close to it. They'll gladly reverse their position to flatten out their position, meaning they have to buy Bitcoin to close out that short position to get out with their account intact. So it causes a bit of a self-fulfilling prophecy. The other side of that coin, of course, is that people have noticed this happen twice, and now all of a sudden they have that FOMO, that fear of missing out. So because of that, you'll have support and resistance kind of flip-flop, and you'll see that time and time again, and that's true in all markets. It's not just the cryptocurrency markets. So the last thing that I would say about support and resistance, it's more important on the higher time frames. So while you can go through on the 15-minute chart and find minor support and resistance levels, The ones that truly matter, the ones that truly move the market, are found on the daily or even weekly. An hourly support resistance area is going to exist, as I mentioned, shorter time frames. But quite frankly, if you find these big levels and you trade from there, you can then drill down to a shorter time frame chart, and you can see that 6,000, the support on the hourly chart, was certainly a nice buy. That didn't change just because you changed time frames. However, when you draw and I'll go ahead and change the color of this support line there, and then you go to the weekly, you can see that it's very minor. You go to the daily, and you can see that it's very minor. Yes, there's been a little bit of a reaction, but the real action is down at 6,000. So by all means, mark those high time frames, the weeklies and the dailies, support and resistance levels, and then trade from there on the shorter time frames. Thanks for watching this video. In this next one, we'll take a look at Fibonacci and Fibonacci extensions. Hello and welcome to the third video of the first module in cryptocurrency trading, how to profit daily with technical analysis by Wealthy Education. This video is about Fibonacci and Fibonacci extensions. Now, Fibonacci is a sequence of numbers that traders will use to predict support and resistance. Now, having said that, it's found throughout nature. It's named after a mathematician named Fibonacci who did most of his work in the early 1200s, and he noticed ratios of repeating patterns in crops and streams, features on the face, and people's reaction to them, those types of things. It's just a repeating pattern through nature. And it's thought that perhaps maybe psychology is influenced by this as well. Suffice to say, Fibonacci has its detractors and skeptics, and my best opinion on this is just simply there's a certain amount of self-fulfilling prophecy to Fibonacci. So whether there's actually something to it or not, it's irrelevant. What is relevant is the market tends to react to it. So very interesting to say the least, and something that a lot of traders use, and therefore people will use Fibonacci, and if enough of them use it, it creates the effect. So at the end of the day, it really doesn't matter. It just matters that it's overall more effective. So TradingView gives you the opportunity to put down these Fibonacci indicators. And the first one I'm going to talk about is a Fibonacci retracement. And the theory is that at certain percentages of an impulsive wave, and in this case we're looking at a downtrend, but it works the same as an uptrend. Once you get a retracement, there are specific levels, percentages of the impulsive wave that you may find a resumption of the overall trend, new sellers coming in. So what if you had a predictive way to find that? That's the idea here. And Fibonacci is widely enough followed that, again, it doesn't matter if you believe the mathematics or if there's anything to it, that there is the self-fulfilling prophecy aspect of it. And at the end of the day, we're here to profit. So the idea is that at these specific levels, you will see a reaction. If you go to the second menu, click on the arrow. This is the pitchfork menu, but it also has many other things, as you can see. You click on Fib retracement, that's short for Fibonacci retracement, and then you have the indicator active. Now, what you need to do is you need to find a swing high, which this was. A swing high is simply the highest point before the market rolls over, or a swing low, which is the lowest point before a market rallies, and then you draw this indicator. So you click on the chart, and you drag, in this case, in a downtrend from the swing high to the swing low, which is down here at this case. And you can see that by default, it forms this rainbow pattern. Now, you can change this, of course, with your usual formatting tools, but this is the default. So what is this telling us? This is telling us that this impulsive move lower, a retrace of 100% of the move, goes back to $304 in Ethereum. The Fibonacci ratios are laid out ahead of time when you put this indicator down, and they will show percentages. There's 23.6, 38.2%, 50%, 61.8%, 78.6%, and of course 100%. So there are a few fib levels that are going to be more interesting than others to most traders. That would be 38.2, 50, which is huge, and ironically not a Fibonacci number according to the mathematical equation, but it's something that's been used long enough that people just take it at face value. And then 61.8, which is known as the golden ratio. Well, you'll notice that the market fell, and then as it started to rally, you can draw your fib, and you can see that just at the 50% Fibonacci retracement level, it started selling off again. And you can use these as guidelines. Now, should you trade solely on Fibonacci? Probably not. But with a little bit of candlestick observations, you can see that there were several shooting stars, which are negative candles, just could not rally. And that showed signs of trouble. Beyond that, there was an impulsive move lower right at that level. So that's another reason to think that perhaps there would be sellers there. And then you have the 50% Fibonacci retracement. So you can see how important that would be as a level. So let's go ahead and remove the Fibonacci tool, and let's zoom out to an hourly chart. It's important to take a minute to look at swing highs and swing lows. So as I zoom out, I'll go ahead and mark a few, give you an idea of what you're looking for. We fell here and we bounced. That's a swing low. We rose here and then we fell back. That's a swing high. Swing low, swing high, swing low, swing high, swing low, and then a breakdown. We didn't even really get a swing high from there. I suppose you could call it that, but that's not enough to be worried about. And you can see that that's just how the market undulates. So that's something that you need to be familiar with. So let's go ahead and look at another Fibonacci tool called the Fibonacci extension. It's based on the same mathematical ratios that Fibonacci came up with. Only this time, what you're looking for is a potential price target, not a re-entry point into the trend. So if you have broken down here, you have already been short, for example, you can go to the same menu and then sub-menu. You look for fib extension, trend-based fib extension. You draw a line from there to your swing low, like you did with your Fibonacci retracement, and then you pull it back to your level, and then you'll notice something here. This actually draws both the Fibonacci retracement tool that we had just done and then these other levels below. And this is based upon the same mathematic equations. So if you're in this downtrend and you're already short, or if you short from here, you can see that there was a lot of resistance here. There was a double top. Price couldn't get through there. As we fall, then you start to think, okay, this is the entire impulsive move, 100% of the impulsive move. Use the same mathematical equations. The next extension level is down here, which we did hit, and then the one after that is down here. So this is a way to project where you may go into the future. Now, I will caution you, extension is used less than retracements. Certainly retracements seem to be more widely accepted and used by analysts. But this is a tool that's available, and some people will actually use both. So definitely something to consider. Again, though, I would urge you to not only base your trades on Fibonacci, but also candlestick analysis, breaking of support and resistance, which Fibonacci is supposed to predict, but make sure that there's structural support and resistance there as well. Make sure you understand support highs, and swing lows and swing highs, support highs, support lows, all of those before you go drawing these. Keep in mind that, like with all things technical analysis related, Fibonacci works better on higher time frames than it does smaller, and that's because it takes more information to fill these charts out. In the next video, we'll take a look at trading psychology and some risk management thoughts and strategies. Hello and welcome to the fourth video in Module 1 of Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. This video is a little less technical in its nature as we are discussing trading psychology and risk management. The thing about trading psychology, and this is truly one of the more ironic things about trading, is that people tend to gloss over it. And at the end of the day, it's what makes the difference between those who are profitable in the market longer term and those who aren't. And in fact, at the end of the day, a market can only go one of three directions. It can either go up, it can go sideways, but it can't do that forever, or it can go down. If it goes sideways, you're not going to lose any money, or at least nothing to worry about. So at the end of the day, you really have a 50% chance of getting the direction right. However, the washout rate of traders is much higher than that. And this is because of psychology. Let's think of it this way. If you have a money manager who's handling your retirement or investment account, who purchases stock in, say, General Electric, and it gets stopped out. Let's say it takes a small loss or even a sizable loss. Are you going to fire that money manager on the spot, or are you more worried that your equity curve just rises slowly over time? I mean, you don't expect a professional to get every trade right every time. You understand that your equity curve will ebb and flow over the next 20, 30, 40, 50 years. So the question I pose to you is, why do you expect something better out of yourself? And that's where trading psychology becomes very crucial, because a lot of times what you'll see is people will refuse to acknowledge that a trend has changed or something serious has changed in the market that they're involved in. And they'll continue to do the same thing, compounding losses. So for example, and I'm going to reference the Bitcoin dollar weekly chart for a lot of this, because I think there's a lot of lessons on this chart. When this candle formed on this weekly candle, somebody who understands technical analysis would understand just how bearish that was. However, there were people saying this is only a momentary blip. We're going to go to the moon. I remember hearing that about Bitcoin all the time. And then we continued to fall, and people just continued to buy and buy. And those people were wiped out. Those people aren't standing anymore, or most of them, I would say. They typically will do things like double down on a position or even take out larger positions, thinking that if we can just rally $1,000 and I've tripled my position, then I can wipe out all the losses from up here and then I'll get out. And inevitably, they stay in because they're starting to make a profit again, and then they lose. And this is fear and greed in its finest. Another thing that this chart demonstrates is the absolute mania in a bubble. And let's make no mistake about it. Bitcoin was in a bubble in 2017. That is not a healthy looking chart. That is a chart that shows no signs of slowing down and has gone parabolic. Parabolic markets always lead to tears. There was no way this wasn't going to happen. Trading psychology was so skewed in one direction that it was ripe for the short sellers. you started hearing about cryptocurrencies everywhere. Around this time, you started to see a lot of people popping up on YouTube who were gurus in other industries suddenly becoming cryptocurrency experts and selling courses on it. When you see it everywhere, it's too late. The smart money gets in much earlier. The technical analysis signals on this chart were everywhere to start buying. That was a good candle. Breaking that candle was a good candle. That was a good candle. That's when the smart money gets involved. There's no need to add to a losing position. When you set your stop losses, you need to decide at what level have you been proving wrong, and you do not move your stop loss unless, of course, you're moving it in the favor of your position. So, for example, if you got in here and you had a stop loss underneath this candle, knowing that, we may or may not be ready to take off, and we've made another swing high, we pulled whack, we've broken above that candle, moving your stop loss to here to lock in profit, totally different story, totally doable, because longer term, you're going to protect your account. Unfortunately, what happens is people who get in up here will put in a stop loss, assuming they put in a stop loss at all. But if they do, say they'll put it at the bottom of that candlestick, and then as it gets close to that, they can't stand the idea of taking the loss, and they'll move their stop loss down here. And then it'll bounce. And then it'll fall. And then they continue to move their stop loss lower because they do not want to take that loss. You have to think of it this way. When you're entering a trade, you're paying for information. So, for example, some of the best traders of all time, and this is long before cryptocurrency markets, would say risk 1% of their account. And the reason for that is because losing a trade or two or three isn't going to cause irreparable damage. Also, they look at that 1% as paying for information. So if you get into the market here, regardless of which direction, long or short, whether you're buying or selling, doesn't really matter. What matters is, what information does that 1% tell you? So let's just say, for whatever reason, you started selling Bitcoin at this level. You thought it was too expensive. You get your stop loss hit. You've lost 1% of your account. Well, you know something now, and it only cost you 1% of your account. You know that the uptrend is continuing. So what do you do with that information? You look for an opportunity to buy it. In this particular case, now, granted, this is an extreme case, but if you risked about 1% here, just on that one position alone, you turn around and make 7 or 8% back pretty quickly. Well, at the end of all of that, you're up 7, 8%. That's really, or 6%. And that's really not something to shake your head at. I mean, that is the essence of trading, making more than you're losing. Understand that you need to have trading strategies involved in your trading. And the most important, of course, is knowing when you need to get out. Taking profits, one thing, but knowing when you're wrong and admitting it will save you a ton of heartache. Not risking your entire account on a trade will save you a lot of heartache. Quite often, you'll get a situation where you're in this cluster and that's when you get out. And you'll notice that these areas do act as important levels time and time again. And that's where the support and resistance comes in. You set your stop loss underneath support if you're going long, or above resistance if you're going short. You let the market prove you wrong. Once you have your stop loss in place, there's not much left to do other than manage your trade. And managing your trade means one thing and one thing only. Moving your stop losses higher as the move goes in your favor to the upside or lower to the downside. There does come a point, obviously, you want it to be a free trade, so you move to break even. And then eventually you gain more and more and you move your stop losses higher. There are hundreds of ways to do this. But probably the simplest is just finding support and resistance levels. I cannot stress enough how giving yourself a break and giving yourself the freedom to look at each trade as one in a marathon of trades that you're going to make. and looking at the big picture, understanding that it's okay to take the occasional loss because you are trying to find out where the market's going to go for the longer term, the bigger money. The big money does not scalp the market every 5 minutes. The big money finds important areas, asks a question, is willing to pay the admission fee, and then does what the market tells them. It doesn't matter what you think the market's going to do. It's going to do what it wants to do. It's that simple. As a personal note, this candlestick here, I remember being in a restaurant and listening to a man who was probably in his early 70s talk to his children about this great new Bitcoin thing and how he was going to buy a ton of it. And I was over and hearing this at the table. And I knew at that point we were close. But it did take another month. Now, I didn't jump into the market and short Bitcoin with 50% of my account at risk because I would have lost half my account. I would have had it taken out this following week. But I knew we were close. And at that point in time, the one trade I knew you couldn't take is to start buying more. There were a lot of commercials out there telling you to do so. But when you see a chart like this, a little common sense goes a long way. Make sure that the impulsive trades that you take, number one, don't exist because you need to have ins and outs. You need to know exactly what you're looking at. But number two, make sure that they make sense. That was a complete breakdown of common sense at this point if you were buying at 18,000. There's no way that could keep up. And now, another aspect of trading psychology that we see all over the internet is talks about, well, happy days are going to be here again because look, we're holding 6,000. And that could very well be true. But these people up here at this point are now praying for that to happen. And maybe they'll be saved. We don't know. But if you're levered to this, you have to multiply that loss by 3 or 10 or 20, whatever your broker allows. In the Forex world, it can be as high as 1,000. So you can imagine how dangerous it is over there. Set your stop loss. Honor your stop loss. Understand that you're trying to find out the bigger move. You have the ability to win 1 out of 3 trades, for example, and still make a ton of money. If that one trade nets 10 units and the other 2 lose 2, you're still up 6 units, maybe think of $100. That's what proper money management will do. I want you to look at the charts. I want you to look for the psychology in each chart that you see and realize that this is a mania. Manias are not good. They get slapped back down. Something like this is much more sustainable. That's another thing about psychology you need to understand when the market is acting rationally. There is a certain amount of rationality to the 6,000 level offering support right now. That doesn't mean that it will hold. And what else could you take from this chart? You could say, well, if we break down below that level, and it's actually somewhere around 5,900, but if we break down below that level, then we know we have further to go. You risk a tiny bit if you're willing to buy, 1% or 2, and as it shows proclivity to go higher, maybe breaking the next high to continue the move higher, then you add to that position. You don't go all in down here in case we flush out. If you do that, your account will last much longer. You'll be much happier. And most importantly, at the end of the day, you will become a profitable trader. Thanks for watching. This is the last video in Module 1. In the next module, we'll start to look at technical indicators and oscillators for cryptocurrency trading. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis, a course by Wealthy Education. You've made it through the first module, and now we're looking at indicators and oscillators. In this first video, we'll talk about one of the most basic indicators, an exponential moving average. Now, an exponential moving average is typically used, but there are other moving averages such as simple moving averages and the like. Really, at this point in time, all you need to know is that moving averages are simply a plotted line on a chart that goes right along with the trend by a certain amount of periods. So what I mean by this is, for example, if you have a 20 moving average, it will take every plotted point that makes up the line will take the previous 20 candles, the average price, for example. Now, it does get a little bit more complicated than that with the exponential moving average. It puts more weight on, say, the first 10 than it does the second 10 candles in that 20 range. But if you were to, for example, see where the moving average was at this point in time, the 20 EMA, it would be the average closing price of the last 20 candles with more emphasis put on the closest 10. It just makes it react a little bit quicker than a simple average, which would just be the average of all 20 of them, with each candle being equal weight. And really, what moving averages do is they just give you an idea as to the overall attitude of the market. So for this example, I'm going to use a Litecoin daily chart. And moving averages are very simple to plot on TradingView, like anything else. I'll go ahead and click the indicators. And you go down and you look for moving averages. And in this case, we'll use the exponential. And as I click that, you'll notice that this comes online here. I'll go ahead and look at the format. And I'm going to make this 9 moving average, exponential moving average, red. You can see that I can also format it as per usual. If I hover over the indicator itself, it's a little difficult to do sometimes because it crosses the candles. So I tend to use that. I'll make this a little thicker. I'll go ahead and do that. Click OK, click away from it, and you can see that I have this moving average. And if you were to run the calculation, it does in fact sit the average closing price of the last 9 candles, in this case 9 days. So what does this tell us? This tells us that we are most decidedly in a downtrend. But you can see that from simply looking at the chart. But some people will look at moving averages as a confirmation of the overall trend. Something that is a bit interesting in this chart. You can see that the moving average is clearly dropping there, but it kind of flattens out. It drops again as price continues to accelerate, and it's kind of flattening out again. So the most recent move in the market has been relatively flat. So that gives you an idea as to the strength. When you zoom way out, you can see that there was an extraordinarily strong uptrend in the bubble top. And you can see that we rallied, we changed, and then fell. Now, some people will simply look at a moving average and say, okay, I'm only trading in that direction. Now, there are other moving averages, obviously, that you can use. So let's go ahead and add another one. Let's go ahead and add a moving average exponential. And I will format it up here because it's easier to do. I'm going to make this blue. I'll go ahead and make it a little thicker. And the input here, I'm going to put 20. So this is a pretty common moving average. The 20-day moving average. So this brings up an interesting point. You can see that clearly one of the moving averages reacts quicker than the other. That would be the 9, and that makes sense. That's your short-term momentum. What you're looking at is the very basics of a trend following system, a moving average crossover system. Some traders will enter short when the fast moving average breaks below the slower moving average because the most recent momentum is to the downside and it's broken a certain psychological support there in the form of the 20-day. And they will short there and they will buy there and they will short there and so on. This is flat. Which brings up the next point with these. These do not work well in a flat market. If there's no trend, you can get crushed trying to trade a trend following system, such as a moving average crossover system. So the other thing that you want to pay attention is the overall attitude of the moving average. And when I say attitude, I mean like a plane, the way, the angle that we're trading at. Clearly we're in a downtrend there. You can see clearly that we broke to the downside. You can see clearly we were in a downtrend before that. Right now, we're pretty flat, so there's no point in shorting. Now, yes, it goes with the longer-term trend, but you would have gotten chopped up for several weeks at that point. And so looking at this, you can see how you enter when it crosses. So you would have entered here long, you would have bought, and you would have exited here short, would have been a small profit. Here, you would have shorted, and you would have bought there, would have been a much bigger profit. So it's not necessarily the most optimized system, but it is something that's used quite a bit by longer-term traders especially. Some short-term traders will use it, but you have to be pretty nimble, and you have to realize that you're going to, by its very nature, get into the trade a little late and get out of it a little late. It is a lagging indicator. It is looking back to perform these calculations. So another potential, and I'll go ahead and close the 20 out, but another potential use for moving averages be the format here. I'll go ahead and change this to 50. I'm going to make this orange just to differentiate it. Okay. So the 50-day moving average is a very common one to be followed by technical analysts. It is dynamic support and resistance quite a bit. Not always. And again, this is kind of one of those things you have to follow the overall trend, but you can clearly see how the market has reacted to it quite obviously several different times. So obviously somebody follows it, right? But this kind of flat moving average got chopped around. So you clearly could have been in some trouble here. This is why moving averages are typically placed with some other type of indicator or support and resistance, that type of thing. And then the final, and you may hear this, this is something that you hear more of maybe in the stock market, but you will hear this occasionally. Something called a death cross. And a death cross is, I'll go ahead and make this black. A death cross is typically referred to as the 50-day and 200-day moving averages crossing to the downside. A golden cross would be the other direction, would be crossing to the upside. So, for example, the golden cross way down there led to a lot of gains. We had a death cross here, and you can see we've fallen. At that point, we were at roughly 126. We're now at 56 as I record this. The 200-day average is considered to be longer-term support and resistance. The biggest problem that you'll run into with cryptos is that, quite frankly, most exchanges haven't been trading enough to make the 200-day moving average that relevant yet. This is more of a long-term kind of buy and hold strategy. But be aware that there is such thing as the golden cross, which is bullish, and the death cross, which we have recently seen, which is bearish, and will send a lot of technical algorithmic traders into a frenzy. Again, though, something that should be used right along with certain types of support and resistance. And even though it's a relatively young market, you can see that the 200-day moving average has acted as both support and resistance as we pass through it. Again, though, this is more longer term type of buy and hold trading, but be aware that these situations do exist. That's it for this video. In the next video, we're going to take a look at using the MACD oscillator. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, we're going to discuss how to use the MACD oscillator. The MACD, or Moving Average Convergence Divergence Oscillator, is a very common indicator used in technical analysis. I'll go ahead and start this video by pulling up the MACD on the Litecoin dollar 4-hour chart just by clicking on indicators, scrolling down to MACD, not MACD strategy, MACD, closing it, and you'll notice that we have a histogram and we have some signal lines, and we also have the 0 line in the middle. All of these will become important in a moment. These are the standard settings for cryptocurrency, though. I'm going to go ahead and change it by clicking the Format button, and I'm going to change the fast length to 9, and that will make it more responsive, the slow length to 50, and the signal smoothing to 9. Okay, so I'll go ahead and click that OK, and I'll walk you through the indicator. So what this indicator is essentially doing, it is plotting the blue line, the 9 moving average, which we have just discussed in the previous video, and the 50, the orange. When they cross, it behaves very much like a moving average crossover system, but the MACD measures the divergence, the strength of separation between these two moving averages. There are a lot of different ways to use MACD, so I'll run you through a few of them. I would state, however, MACD is not something to use by itself. It's typically in conjunction with other indicators in a system. So the most obvious place to start would be the crossover. And you can see that as the MACD moving average is crossed over, we broke down and started to fall, and that's exactly what happened. We flattened out, the market bounced a little bit. We get another signal to sell, and you can see that we break down even further. Over here, we get a crossover right about here, and you can see it broke down. Now, since then, we have been crossing to the upside, and we are trying to pick up momentum. I would point out a couple things, though, about the crossovers here. One of the things that makes them a bit more interesting is that they are so far in the lower part of the indicator. So here we have the 0 line, and you can think of this as bullish and bearish momentum. So when it crosses in the bearish area, that means that the buyers are starting to push price higher. And that's what we're seeing in the sense that we have been stabilizing, just as the market had been rallying and the sellers stepped in. So that's something to pay attention to. In the MACD, you will also see people look at the 0 line and just simply trade it in whichever direction we break. So for example, we broke down below it here. Traders would be selling at that point. Over here, we peaked above it, probably would have gotten out about here or close to it. Nice little profit if you're short of this market. However, again, this is a marketplace that is very volatile. So cryptocurrencies especially, you should be using other things like support and resistance to back up your MACD signals. And finally, there is something called divergence, and that is used using this histogram, which measures the divergence of the two moving averages. And essentially what that says is that you're looking for a scenario where price and momentum are completely different, like the price is moving in a different direction. So I'll go ahead and zoom in on the daily chart and see if we had some type of divergence. And yes, we did. These don't happen all the time, so when you see them, it's worth taking notice. You'll notice that this price had been rising over these several days. But at the same time, the MACD was falling. That's a sign that you're losing momentum. And we did, in fact, fall from there. Now, divergence is something that doesn't happen very often. But when it does, it shows you that even though you're rallying, you're losing a lot of buying momentum. Or it can work the other way, obviously, if you're losing selling momentum and the histogram is rising. So you can see there are a lot of different ways to use MACD. I tend to use it as a secondary indicator, giving you a reason to think, okay, well, we're running into resistance here. The MACD is turning down as price is rallying. Perhaps we're going to run into some trouble. There's a candlestick here that's exhaustive. It's a shooting star shaped candlestick, which is a very bearish candlestick. That's 3 reasons to think about selling at that point. Thanks for watching. In this next video, we'll take a look at the stochastic oscillator. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to take a look at the stochastic oscillator. This is a very old oscillator that people use to trade range-bound markets. It's not very reliable in longer-term trends, so typically trend traders will ignore it. But if you find yourself in a market that's chopping around like this is, it'd be great to know when it's overbought or oversold. So the first thing that you need to know is that it's placed in the indicators list here. You just drill down to stochastic, click on that, and it pops up in the second window. You can see that there's and these are all the standard layout for TradingView. You can change all of this, of course, but you can see that we have a lavender area in the middle, and think of that as no man's land. That's an area where you don't place trades. Then you have moving averages that cross occasionally, and then you have the 2 white areas above. 20 and below to 0 is oversold, 80 to 100 is overbought. What you're looking for is a signal cross in the overbought, because it's a slow and a fast momentum moving average that's crossing. Gives you an idea of perhaps a area where you're going to see momentum die off and swing the other way. So the first thing you need to do is recognize, again, that this is a range-bound trading type of indicator. So you can, for example, identify this as range-bound. Then you can identify these crossovers as signals. Here's a great one here. You had it cross over in the overbought area. It's time to sell. You had it cross over in the oversold area. It's time to buy. Over here, you got these same signals. Here, you got that same signal. And you can see it just goes back and forth. And when it works, it's a beautiful thing. The problem, of course, is when the momentum shifts and you become trending again. One way to work around that is putting a moving average, and I'll go ahead and put that there. And I'm going to use a little bit longer term moving average. Go ahead and put the 20, and I'm going to thicken it out a little bit so it's easier to see. And you can see that the moving average kind of just wasn't really doing much then. It was just kind of bouncing around. That's how you identify a range-bound area. And it'll be especially obvious in the higher moving averages as well. So you can see that the 50 certainly had flattened out. So at that point, then you begin to look at the stochastic oscillator for overbought and oversold areas. Again, the area that I'm looking at least at this point, is here. And you can see that there were sell signals up here, buy signals there. Now, eventually we blew through it. And that would have me ignoring the stochastic because it's not built to function in that environment. That being said, the stochastic oscillator is great for shorter term charts, longer term charts, especially in the cryptocurrency markets. So I'll come here to the day, are going to be a little bit more challenging, mainly because the cryptocurrency markets are so volatile that the consolidation on longer term charts tends to take a very long time. And one could even argue that the sell-off in Bitcoin has not been consolidation because the lows have gotten slightly lower and the highs slightly lower. So it's more of a general drift lower at this point. But if you're looking to scalp the market on a smaller time frame, then you see this constantly. You see a lot of consolidation. And even in this little bit of a move, for example, you can see that there was a sell signal and a buy signal down there. Very quick oscillator to use, great for especially quiet markets. In the next video, we'll take a look at the Bollinger Bands, which are one of the most common indicators people use to measure volatility. Thanks for watching and see you there. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to discuss Bollinger Bands. Now, Bollinger Bands are decades old and a very common instrument used in the financial markets. Bollinger Bands work on the two standard deviation phenomenon that you probably learned in a math class at one point in your life, where the average price is right in the middle of the bell curve, two standard deviations at the extremes, and as a general rule, most pricing, most numbers, whatever, fall within this range. This is basically the same thing Bollinger Bands are predicting with. So Bollinger Bands, you can just click on indicators, click on Bollinger Bands, close it out, and you can see we have three lines that are filled in with a green, and of course that can be changed like anything else in TradingView. But what this is the 20 SMA, simple moving average, on the daily chart, and it does work on smaller time frames. I mean, you can see that it traces price right along as it typically would. But now we have outer lines. And these are two standard deviations from the 20 moving average. So two standard deviations at this point would be right here where this price is. Two standard deviations below would be down here, from here, etc. So how do you use this? Well, there's a couple different ways to use this, but typically what people will do is they will follow the moving average. So they don't have any interest in trying to, for example, as we rolled over here, they would not be looking to buy. They would recognize that as we approach the two standard deviation area here, that could be a sell signal. Now, the question is, do they want to take profit at the moving average, which is considered to be fair value, if you will, or do they want to aim for the lows? Well, that really comes down to how aggressive you are. That's part of the choice that you make, if you will. Most traders will at least try to aim for the middle line, though. An even better signal would have been this one here. The trader would notice that the moving average was turning up, but they would have also seen a shooting star at an area that should have been resistance, 12,000. It pierced the Bollinger Band, but then turned around. So even though this is a counter trend trade, at least technically due to this, those who believe in taking counter trend trades and that a reversion to the mean is probably going to happen would have shorted there and aimed right for where we stopped. But in another shooting star at this area, you can see that we broke down through there. There are a lot of different ways to use this, but for example, I think the shooting star here, almost touching that, was probably reason enough to short it. We had definitely gotten overextended, but you would have only aimed for the middle line because it's counter trend. You're not necessarily going to be thinking about aiming for the complete opposite side. That's very aggressive. Obviously, it would have profited you quite nicely, but most of the time that doesn't happen, at least not easily. We broke down below this hammer here. This is the original one I showed you. That makes that what is known as a hanging man. That's a bearish sign. We went to the first and then eventually did touch the bottom. I'll go ahead and switch to an hourly chart. And you can see that in the hourly chart, it becomes a lot more active. We break out of here. We form a couple of shooting stars. It makes sense that we'd pull back to the mean at least. Same thing here. Now, at this point, you can definitely see that a lot of this just plays going back and forth from this line. You can think of it this way. Price typically falls right around the moving average. If it gets a little too far in one direction, you're just trying to bank on it going back to the moving average. If you're more aggressive, you know that markets fluctuate and you try to aim for the other side. By their very mathematical nature and definition, Bollinger Bands will not let price get too far outside of the range, because at the same time, the moving average is moving lower or higher, depending on how that plays out. Now, typically, people will use Bollinger Bands with support and resistance. So I'm going to draw a horizontal line here, and I'm going to format it at 6,600. It's an area I'm eyeballing here as resistance. And you can see there were probably several trades that could have been taken. We got a little overextended here. We pulled back. Definitely got overextended here. Pierced through there, pulled back. Same here. I pointed that out earlier. And then same here. So you can see that not only does the resistance hold, but the Bollinger Band signal holds as well. But you can say the same thing about this here. We had gotten oversold. We went right back to the middle. So it does work both ways. It's a very active indicator, and quite frankly, the whole idea of reversion to the mean is something that a lot of algorithms are programmed to detect. So as time goes on and we get more high-frequency trading, it has certainly helped the Bollinger Band indicator. Thanks for watching this video. In this next video, I'm going to put several things together using indicators and show you how you may be able to profit from a combination. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, this is putting everything together. I'm going to run through some examples using the indicators that we've been talking about in the previous videos to give you an idea of how all of this can tie together. So, for example, on the Bitcoin daily chart, I have the Bollinger Band indicator. I also have the MACD. Here you can see that we had a green candle at an oversold position, 2 standard deviations underneath the moving average. On high volume, very high volume goes all the way up to here, so that shows that there's real conviction behind the little bit of price movement we saw. And then shortly after that, maybe the next candle, we see a moving average crossover in the MACD. It's a buy signal. You can see that we did, in fact, go all the way to the midline and beyond. We touched the outer part of the Bollinger Band. That would be a signal to get out, just as this was a signal to sell with a moving average crossover in the MACD and a breaking below the average line. As we drift along, you can see that we are continuing to stay within the 2 standard deviation range for the most part. So every time we break through it, there is a chance that we pop. But now we're going to counter trend if we're doing that. So a little bit more caution would be advised. On this crossover and higher volume, we broke through the top and then walked right across till we saw this area here, which was higher volume. And then eventually got the cross here and drifted towards the bottom. So as you can see, those two can work quite well together. Over here in the Ripple hourly chart, I have 2 indicators on the chart. I have the stochastic oscillator on the bottom, and I have the 20 EMA on the chart. The 20 EMA I will thicken here just to make it easier to see. And now you can see that we had a nice uptrend going. So at that point, you're ignoring the stochastic. But as we start to chop around and go sideways overall, suddenly the stochastic becomes interesting. You can see that the market struggled a little bit here. And it also struggled a little bit here. So at this point, you're looking at the stochastic oscillator because the moving average really isn't doing much. And you can see where we crossed over in the overbought area right here. And in fact, we got a sell signal right here where we bounced slightly. We got 2 more sell signals right around this candle where we bounced slightly. We did cross over here at the top of resistance, but it was not in the overbought condition. So at that point, you would default back to your resistance. You'd say, okay, well, we have struggled here recently. Why is it a surprise that we may pull back again? This is a perfect example of using a couple of indicators to set things up for a successful trade. You'll notice that with the EMA rising and all of these sell signals, you would have lost money, and that's because you're trying to use the stochastic oscillator in the wrong environment. Finally, in this last example, I will show you Ripple, hourly chart, stochastic, Bollinger Bands. So remember, stochastic is a range-bound oscillator, so as we start to turn up, we ignore stochastic until we flatten out. Again, as we turn up, we ignore it until we flatten out. However, it can be used in conjunction with the Bollinger Band. So as we became overbought and crossed over, it gives you a little bit of confidence. We touch the top of the Bollinger Band again, crossed over in the overbought section, and you can see that we went down to the midline. We touched the bottom of the Bollinger Band, oversold crossover. It's a buying opportunity. It's a buying opportunity over here as well, although the Bollinger Band has tightened up. And what does that tell you? That tells you that the standard deviations are getting smaller and volatility is falling. As you can see, by marrying up a couple of indicators, you can come up with a really strong system. A lot of it comes down to personal preference and comes down to feeling confident about your trading system. But if you use indicators like this and you use money management so that you're not risking too much, over the longer term, you too can become very profitable in the cryptocurrency markets. In the next video, we'll put all of that together again, but this time we will add Fibonacci. Hello and welcome to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to show how you may choose to trade technical indicators with Fibonacci and Fib extensions. So in front of you, I have the Bitcoin dollar daily chart, now famous because of the popping of the bubble. And you can see that there would have been a couple of things to pay attention to. We got to the edge of the Bollinger Band a couple of times at the same level, and that, of course, is sign that perhaps we're going to run into some trouble. You could have shorted based upon the breaking of a couple of hanging mans to the downside, and therefore that could have given you signs of serious trouble as well. But regardless, let's say you missed that and you see that we're rallying, but now you have seen such a sell-off that you have to start thinking, okay, the moving average is turning lower. Let's draw a fib and see what happens. Well, we draw a fib, and you can see that at this point, we rallied to the 61.8, formed a hammer-like candle, broke below it, making it a hanging man, and that in turn is a sell signal. Using the Bollinger Bands, you can see you could have taken profit there or there because you're going with the trend. You may have been a little bit more aggressive, but at the very least, you would have taken profit here. So that tells you just how powerful these two things together can be used. Let's go ahead and perhaps look in the other direction. So at this point, you could take a fib retracement, look for the swing high, see that we reached the 50% Fibonacci retracement level, and that would have been a nice buying opportunity. A lot of volume picked up here on that green candle. That would have been a good sign, and you can see that would have got you in on the huge move. So let's go ahead and remove that. Let's say you're already in it, so where are you going to go? What are you going to aim for? Well, this ought to be interesting because we had such a large move. As I draw the fib extension tool, you can see that there were several levels that you could have aimed for, and in fact, you almost got the third one, which is very rare. But at this point, you can see that on the pullback to the 50%, the first one was hit rather quickly. A couple weeks later, the second and the third was almost hit. Of course, you would marry this with the Bollinger Band. You broke above it once you hit the first one. That probably would have gotten you out with a really nice profit. And then, of course, you could set up for future trades. So over here in Bitcoin Cash, you can see that I have a trend following system set up. I've got the 20 EMA and the 50 EMA drawn up on the daily chart, and you can see that I also have volume up. Volume is very important in this market. And you can see that we had a pretty strong run higher. And in fact, you can take the retracement tool on the crossover there. You can see that we started to rally initially. And when we came back, the 78.5 offered a lot of support. The moving averages were both in the same direction, going higher. They had already crossed. So that was confirmation that we were probably going to continue to the upside. Let's take a look at the extension and see what we get there. Okay, so you can see that we pulled back and then extended to the first one right there. All of that within a single day, which at that point, if you had spiked $1,500, $2,500 in a day, it's time to get out. With that type of volume, it's hard to imagine that you're going to be able to keep that up. But you can see that even in this crazy move, we hit the first target. And the point is this. You can take any type of trading system that you set up, moving average crossover system, Bollinger Bands, something like that, and you could take Fibonacci and apply it to it because so many other traders are using Fibonacci, be it extensions or retracements. And I will reiterate this that I said earlier. Retracement tools are much more common for people to be using. And it's always wise to know basically where you are in the Fibonacci sequence. It's not necessarily the sole reason to take a trade, but if you have a couple of other reasons, just like anything else, the more reasons you have to do something, the more likely you are to succeed at it. So by all means, as you're starting to use your indicators, use the Fibonacci on top of it and see if there is a correlation that makes sense to you. Thanks for watching this video. This concludes Module 2, Technical Indicators and Oscillators for Cryptocurrency Trading. Stay tuned for Module 3, Chart Patterns for Cryptocurrency Trading. See you then. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, we begin Module 3, Chart Patterns for Cryptocurrency Trading. In this video, subject will be how to trade double tops and bottoms. And as you can imagine, it's pretty self-explanatory. A double top or a double bottom is an area that has shown itself to be the top of the market or the bottom of the market at least twice. There's also triple tops and triple bottoms, which essentially mean the same thing except for 3 times. So if you can imagine a plane of resistance, the market has touched it, pulled back, touched it, and then failed. That's a double top. Double bottom, of course, is the exact opposite. The market falls, bounces, falls, and can't break down through there and takes off to the upside. Pretty self-explanatory. So how do you trade them? Well, there's a couple different ways you can go about it, but in the Ripple 4-hour chart here, I have an example of a double top, and you can see that price reached up here to about 97 cents and rolled over. Now, you can clearly see that it couldn't break above there the second time, so as we're breaking down, there's obvious resistance there. Now, depending on how aggressive you are, you could measure the bulk of the body and perhaps aim for that, which is pretty much exactly where we ended. Or you can recognize that a double top at an extended run like we had could be major, perhaps even long-term resistance. So you rode this through and you can see that it eventually broke down. It's just an area where the buyers couldn't overcome. Now, this is a particularly interesting chart, and the reason I chose this was because it also has a double bottom that was preceded by the double top that I had talked about. So looking at this, it's pretty easy to see that there's some resistance there, and this double bottom formed. We broke down. We couldn't slice through the 80 cents level, 82 cents level. We bounced a bit. We came down, and we bounced again. Well, where do you think that was always going to go? That was always going to go to this double top that was going to be resistive, and then we broke down from there. Another thing that you will hear these referred to as, and it should be very apparent why, M patterns, and over here, the double bottom, the W pattern. Now, you want to see a double top at an extended run higher. You prefer to see a double bottom at an extended run lower. So as I look at this chart longer term, you can see that there are support levels that get tested time and time again. These levels are areas where you look for double tops and double bottoms. This area here formed a little bit of a double bottom in this area, right around 42 cents. And you can see we went straight up to the recent high and then rolled over again. So by recognizing that the market had tried to rally, failed, and then came back and tried to rally from the same spot, as it's rising, you need to be looking for a potential buying opportunity. And where do you expect the first trouble to be found? At this swing high, as you've been learning with support and resistance. So you can see the power of these patterns. And they do happen quite a bit. They can happen on any time frame. It's really like anything else, you want to pay more attention to the longer term time frame. So like a double top on a weekly chart is much more powerful than on an hourly chart. This is a triple top. I'd mentioned there are some triples. 3 different times that we could not break above 47 cents. And you can see we did in fact break down from there. Where did we go? Right down to 44 cents. Which was the scene of a major reversal. So, look at your charts. Look for 2 and 3 attempts to break through a level and a failure. Those are the areas where the market is telling you, in not so subtle terms, I might add, that the buyers or sellers just simply can't get through. You need to recognize these levels, and you need to realize that although there is no 100% certainty to these double tops and double bottoms, when you do play them and you do follow the market when they rally from a double bottom like that, you are definitely increasing the odds of your trading. And after all, that's all we're trying to do. In the next video, I'll take a look at rounding tops and bottoms. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to take a look at how to trade rounding tops and bottoms. And the first thing I like to do, of course, is explain exactly what I'm talking about. A rounding bottom or a rounding top, and typically you hear it referred to more as a bottom, is a reversal pattern, but unlike many other patterns, there aren't as many stringent rules, if you will, in defining one. What you're basically looking for is an overall move like this in the market, and quite often they take quite a while to occur, and that is a rounding bottom. It's literally the market just rounding and then rolling to the upside. Same thing with a rounding top. You're trying to rally and then you just kind of fade lower. These are typically not very sudden moves, but they take so much time to occur that it does show there's a certain amount of conviction just by that very nature. Here on the Ripple Dollar 4-hour chart, you can see that we have a bit of a rounding bottom pattern here. It's not perfect, but they never are. That's kind of the point. But what we do look at is we look at the fact that the market drifted lower and then drifted higher. Where is the top of the rounding bottom pattern? Well, you can see that there's several areas of resistance here at 70 cents. Where's the bottom? It's basically here at 45 cents. And you can see that it's rounded off quite nicely. So when you get these areas mapped out and you break above with volume, as you can see, which always helps, you measure the distance here, and that is 25 cents in this case. Well, 25 cents from the breakout at 70 is 95 cents. And that's exactly where we hit, not once, but twice. It's a very handy little measuring stick, if you will, the top to the bottom. And you'll see that a lot with various patterns. Rectangles, head and shoulders, wedges, flags, those types of things all have measuring calculations kind of built into the pattern. So over here in Ethereum, I have a smaller example, but it is a rounding top nonetheless. You can see that we rounded here. You could even make a case for a double rounded top or even a double top. It's all kind of the same thing. So you have to be a little bit careful with this, worrying about semantics. But as we round top here, 520 to 545 roughly is the height of this rounded top. So as we break through 520 with volume and an impulsive candle, at that point you're looking for a $25 drop. In other words, $4.95. And you can see that's basically where we ended up before we had a couple of sideways candles here on the hourly chart. One of the things that you need to pay attention to when you're trading patterns is to understand the underlying psychology. In the original case, over here in the Ripple chart, you can see that the market drifted a little bit lower, and then there was a lot of complacency, and then we rallied. The market became very comfortable here and then took off. Well, the sellers are very uncomfortable at this point, so it becomes a self-fulfilling prophecy. We just shoot to the upside. In the Ethereum chart, in the rounded top, people had started to buy this market, but then it drifted against them several hours in a row, and then eventually everybody that had bought from here up started to lose money. Well, they had to flip their position around to close it out, creating bearish pressure that not only fulfilled the target, but went lower after that. Pretty straightforward stuff. You can make an argument that this is basically just rounding with support and resistance, because when I go back here, for example, in the Ripple chart, you could just as easily say there is a resistance level at 70. We broke above it with some volume. That's reason enough to buy. You don't even have to worry about the pattern. But you can also say that that's the trigger from this rounded bottom, and you just measure the entire pattern, extrapolate it out to 95 cents, and you've hit it. So it's kind of a nuanced approach to support and resistance, but they do tend to attract a lot of attention. And the longer the time frame, the more interested people become in them. You know, for example, here on the daily chart, eventually you see these appear like right here. We kind of rounded a top here on the bounce, and then we got down to there. So this is something that carries over from the stock trading world, catches a lot of attention over there. You know, a rounded bottom on a stock like General Electric, for example, or IBM that's been around for ages, attracts a lot of attention because these rounded bottoms in those stocks can go 2, 3, 4 years. So it truly means something. Works on all time frames, but again, the higher the time frame, the more interesting it becomes to technicians. In the next video, I'll take a look at how to trade rectangle tops and bottoms. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to take a look at rectangle tops and bottoms, how to trade them, and define what a rectangle is. Well, a rectangle is exactly what it sounds like. There's really not a whole lot to it. Rectangle shape will define how the market's been trading. Basically, you have resistance that's well defined and containing the market. At the same time, you have support that's doing the same thing. And you may have price just kind of bouncing around in this little area. It's consolidation. The market doesn't have any real conviction one direction or the other. Typically, what happens is eventually you get an impulsive move and you break out. So in a downtrend, typically the rectangle will be a continuation. Eventually you continue the trend. However, there are times where it reverses, and that's what we're talking about here. So you can mark up a rectangle on TradingView by clicking the brush menu and then rectangle in the sub menu, and you just simply drag it like this. Of course, you can change the format and all of that. I'll forgo that right now, but you can see that there is certainly a rectangle here of resistance and support. So what happens? Well, we eventually break out. Now, the beauty of rectangles is that you can measure the rectangle itself and use that as a potential initial target. And in this case, I'll just slide this rectangle higher and put it where it once was. And you can see that we did, in fact, hit that target. We hit it rather quickly. Now, that's not a huge surprise with NEEM. It's a somewhat illiquid cryptocurrency, but you can see that it was the bottom so far. And in fact, we have come back to test this area, and so far the bottom support has held. So this gives you a target immediately, or you can choose to have your stop loss at the bottom of the rectangle. It really comes down to your risk appetite more than anything else. Keep in mind, though, rectangles occur all the time. They don't necessarily have to be at tops or bottoms. So I will draw another rectangle here. Not a very exciting one, but it is a rectangle nonetheless. It's in a downtrend, and it has broken to the downside and fulfilled its potential target. So keep that in mind. Remember, when we talk about markets and trends, they tend to consolidate large amounts of time. Some markets will actually consolidate as much as 85% of the time. If you wish to go back and look at the stochastic oscillator video, that is an excellent indicator to use with these rectangles. Now, we can also have rectangle tops, though. And I'll go to the brush menu, pull up the rectangle. And you can see that there is a bit of a rectangle going on here. We clearly have resistance in the Ethereum market right underneath 420. And 415 or so is the support. And we rallied quite nicely, and now we have broken through this rectangle, and that shows a reversal of attitude. You just simply extrapolate the distance of the rectangle down, and you can see that we did in fact hit that target just a couple hours later. Again, though, you can look for rectangles on any chart, any time frame. Rectangles on higher time frames mean more, obviously, because it takes more information to form them. And that's going to be true with almost everything technical analysis related. So in conclusion, what we're looking at in rectangle tops and bottoms, if it was a line chart, it would basically look like this, and then you roll back over in a top, and then of course it's the exact opposite in a bottom. But keep in mind that these rectangles also can occur in the middle of a trend. which is why you wait for them to break one direction or the other, and then just simply follow. In the next video, we'll look at head and shoulders patterns, identify them, and how to trade them. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, we're going to take a look at head and shoulders and inverted head and shoulders patterns, describe what they are, and show you how to trade them. A head and shoulders pattern is drawn like this on a line chart. Basically, you have the left shoulder, the head, and the right shoulder. And you can see why. There's basically a peak, a second peak, which shows that we're continuing the uptrend, but the third peak fails to continue, making higher highs. That's the first sign that you might be running out of momentum. Furthermore, it comes with a neckline like that, and once you break down that neckline, it confirms that the momentum has run out, and it is a reversal pattern at that point in time. The inverted head and shoulders, as you probably can guess, is the exact same thing except for backwards. You got the head and the shoulders there. Essentially, what this means is that your selling pressure is abating. You get another low and then you can't make it happen the third time. I would also point out that these can be what is known as complex patterns. So in the case of the head and shoulders, you can have like a double little shoulder there and then a head and then a shoulder. Really what matters the most is that you have an inner peak and nothing else can get past it. And again, you would have a neckline just as you would with the simple pattern. So here on the Bitcoin Cash dollar chart, I have a head and shoulders that I'm looking at right now. And I'll trace it for you. As you can see, now that I've drawn that, it becomes a little bit more clear. There's also a neckline here that price had struggled to break through. So one of the great things about head and shoulders patterns is that everybody sees them. It's such a widely traded pattern. There is a built-in measure stick, if you will, from the neckline to the highest point of the pattern is what you're expecting to see as far as a profit target once you break down the neckline. And you can see that we easily did that, just eyeballing it, because not only did we test it here, we went much lower. A lot of times, traders will come back and try to test the neckline, and just as it does in a trend line, it offers resistance. Over here in the Ethereum chart, I have an inverted head and shoulders, and I'll go ahead and trace it here. It's a little bit more complex than the previous one, but it is an inverted head and shoulders nonetheless. There's your neckline. There's your measurement. You can see we clearly made that move. It's a reversal pattern. It's a very widely followed pattern. And it makes sense. It just flat out makes sense if you think about it. Because as we were falling, the sellers became more and more confident. But the fact that they couldn't continue to push things lower has people concerned. There are a ton of orders in this area. And once we break the neckline, those orders need to be reversed because they're losing money. Now, I would caution against trying to trade head and shoulders patterns in the middle of a move, because a lot of times people will look for them in the middle of a trend, and you don't want to see that. You want to see this neckline broken. You want to see it decisively broken. You want to see a candlestick close outside of that head and shoulders pattern. You can see that this candlestick came back to test this neckline for support. It found it, and you could have got in there, picked up that little bit of money waiting for you in the marketplace. Again, it's a self-fulfilling prophecy. So many traders pay attention to these patterns that they are remarkably resilient. Now, with all technical analysis patterns, the higher the time frame, the more interesting it becomes and the more likely it is to work out. The stop loss can be put in a lot of different ways. For example, had you taken this inverted head and shoulders pattern on the breakout, a lot of people will put it past the shoulder. Some people will actually put it past the head. It really comes down to how much room you want to give the trade to run. In this next video, we'll take a look at how to trade a pattern known as cup and handle. Hello and welcome to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, we're taking a look at the cup and handle trading pattern. Unlike many of the other chart patterns that we discuss in this module, this does not have an inverse. But a cup and handle is pretty straightforward. It's supposed to represent a teacup. Basically, it's a rounded bottom, which you've learned before, and then it's got a little bit of a pullback and then eventually a move higher. It is a reversal signal. It's a bullish reversal signal. It doesn't happen that often necessarily, but it is something that a lot of people will follow. There is a possible measuring stick with it, but most people use it for a trend change period. They don't even necessarily try to measure it. They just take advantage of it. And think about the psychology that's going on here. We are in a downtrend and things continue to go a little bit lower and people feel better about it. And then it just kind of quiets down. Some people will take profit. Eventually more people will take profit. And then people will begin to be a little bit more concerned. We start to drift off and then eventually we pick up some momentum and trading starts to pick up again, a lot of times with volume, and it just confirms a reversal pattern at the bottom of a larger move. So on this chart, I have a short-term cup and handle pattern. You can see that there's the rounded bottom, if you will, and then there's the handle. The handle always pulls back slightly, and then you get this massive amount of volume, and then Bitcoin just takes off. So there's a couple different ways that you could have traded this potential move. You could try to measure the cup and handle like this. So there's your handle, and then there's your entire height from 8,000 to 9,000. And then on the breakout above the top of that, resistance barrier, you add 1,000 because it is $1,000 thick, if you will. And your target would have been 10,000. You can see that we did, in fact, have a little bit of a reaction there, but why wouldn't you? $10,000 is a very large round number. And then you just continue higher. You could have traded it that way. You could have put your stop underneath the handle. Some traders will just simply hold because they believe that these patterns, these cup and handle patterns, are so monumental that they just assume that the trend continues. And in this case, that would have paid off all the way to 11,750 before we got a significant pullback. You can see that there is a lot to be said for this pattern because it is complex. It takes so much time to set up. Remember, you've got all of that. It's not even really selling pressure. It is in the beginning, but after that, the market just seems to lose interest. And then there's another attempt to fall from there, and then it doesn't. So while the pattern is called the cup and handle, you could almost make it something along the lines of a downtrend followed by general lack of interest, another attempt to continue the downtrend, followed by a complete lack of interest. So think about the psychology always. You should always think about the psychology of what the participants are feeling on both sides. This high volume green candle that breaks out of resistance has the buyers feeling pretty good. At the same time, the sellers feel bad. They have to reverse their position, and then we continue to rally. Cup and handle is a pattern that matters more on higher time frames, but the cryptocurrency world is fairly new, so you don't see this a lot, say, like on the daily and certainly not on the weekly charts. However, it has its roots in the stock market, which, of course, a stock like IBM or some of the other stalwarts like Amazon, Apple certainly conform these, and these can take place over weeks, if not months. Shorter time frames, of course, happen, like this example, and they do mean the same thing. And in the cryptocurrency world, that's pretty much where you're going to find these. In the next video, we'll take a look at wedges and flags. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to take a look at wedges and flags, how to trade them, and identify what they are. So here we have the Ethereum $4 4-hour chart. And first, I will describe a flag. And you should know that there is a bearish and bullish version of flags. And a flag is essentially a pattern that looks like this. Now, let me explain what we're looking at here. This is a rising market that then consolidates between two levels of support and resistance. So this is essentially the flag pole. And that's the flag itself. The idea is that once we break the top of it, we continue to go higher. Beyond that, it has its own measuring stick. That would be the pole. And the other thing that I would say about flags that unfortunately most people seem to forget, and I think this gets them into a little bit of trouble, is that you need that uptrend, and then you need the pullback to be against the trend. Now, they also work in the opposite direction. There's a bearish flag. Same thing, it's just a flag that's upside down, and that's what we have on this chart. You can see that we had dropped down rather significantly here on the 4-hour chart. And I'll go ahead and I'll use trend lines free-handed to draw this out. You can see that we had an area there that market went pretty much straight down, and then we consolidated just like that for support, and just like that for resistance. Well, that's a bearish flag. Now, the great thing about this pattern is, like I said, it has a measuring stick built into it, and that's the pole. So you can just take this pole and extrapolate it down on the breakout, and you can see that's pretty much exactly where we went before we bounced again. The great thing about this pattern is that so many people pay attention to it. It's a self-fulfilling prophecy, if you will. For a bullish flag, it's just the exact opposite. Now, think about the psychology. In this particular move here, the sellers were feeling pretty good, and then they just kind of took a break. But you'll notice it's not a steep pullback. It's just a slight pullback, some profit taking, if you will. Whatever fundamental reason drove the market lower picks up again, and people join the fray. This gives those who didn't catch the initial move the opportunity to start shorting. So that's a flag. Now, a wedge is a little bit different animal, and that's mainly because it's opposite of what you would think it would be as far as its directionality. So what I mean by this is that a wedge is a constriction of price, if you will. So we're just kind of banging around in a little area, getting narrower and narrower, and then eventually we break down, right? Except for most wedges appear with a bias. And as this is a rising wedge, what happens is eventually we break through that and then the sellers take over. It's a constriction of price and then it's a destruction of the support. There is also a falling wedge, which might look more like this. And then price will bounce around in it and then eventually break to the upside. It's a failure of the selling pressure. Really, that's probably the best way to think about it. It's just a simple failure of pressure. So here's a wedge that was a rising wedge. And you can see clearly that we broke through it and then drifted lower. You could also make an argument for this wedge over here being a decent signal. The biggest problem you'll have with wedges like this is that they only become obvious after the fact. And these are rising wedges. The bottom's rising. A falling wedge, you could make an argument for this. But the biggest problem with using wedges per se to make a trading decision is you can also simplify this. And you can, let me go ahead and remove all of this and I'll show you. You can simplify this by simply saying, well, there's a short-term uptrend line that was broken. And essentially it means the same thing. So, price is constricting a bit, but really most traders will just pay attention to the uptrend line being violated. But do be aware that there are wedges out there and people do talk about them. So it's kind of 6, 1/2 a dozen or the other, truthfully. In the next video, we'll take a look at trading other consolidation patterns. In this case, the triangle and the pennant. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, we're going to take a look at triangles and pennants. Now, a triangle is exactly what it sounds like. Simply a constriction of price into the shape of a triangle. Now, I would point out that triangles can be symmetrical. They can be descending, and they can be ascending. So basically, you can draw trend lines in a symmetrical pattern, a descending pattern, or an ascending pattern. So, for example here, you could make this a symmetrical triangle. And it's pretty straightforward. It's a nice couple of short-term trend lines. You break down through it. So the question here then is, let me go ahead and use the tools here because I can extrapolate this out much easier with the proprietary TradingView tools. But let's go ahead and draw these trend lines. So the question here is, how do we know what our profit target is? And just like with many other technical patterns, it comes with its built-in measuring stick. It's the height of the triangle from the lowest to the highest point. And you just simply move that line over there, and you can see that we did stop there, but we continued to go lower. Now, that's not a bad thing. That's just a thing. But certainly your profit target was hit, and you'll notice that it was where this support had been found previously. So I mentioned that there are a couple different types of triangles. So let's point out a different type here. This is the descending triangle. And as you would expect, the descending triangle is bearish because price is descending. It's pressing against support. So think about it. There's a line in the sand there, but the sellers are becoming more and more aggressive, and finally they win the argument, right? And again, you just take this height to support here, bring it down, and that's your target. And you can see that we did hang out around that area for a while. Now, an ascending triangle is just the exact same thing. Just flip it over and you've got prices rising. Eventually you break resistance, and then you take that high to low, and then you bring it up, and you simply aim for that target. Now, the other pattern in this video is the pennant, and the pennant is basically the same thing as a flag, but instead of the pattern, if you remember from the last video, we had a rally or a drop in a bearish flag, and then a pullback that had a parallel lines that held price in, and then a continuation in whichever direction. A pennant's a little bit different in the sense that you do have the pull, but it, number one, doesn't have to be a pullback. It can just be sideways with a tightening consolidation. And you can see that it basically can be thought of as a triangle on a pole. And that's what makes it a pennant. And of course, it's got both variations. It doesn't have to be a symmetrical triangle. It can be more like this. But thinking of it as a triangle on a pole is probably the best way to go about it. So the example I have here on this chart is a bearish pennant. And I'll go ahead and draw this out. Remember, there is a flagpole. And that flagpole is very important because once you break through the support here at the top of the bearish pennant, you then take that and you make that your target. You make the flagpole your target from the top of the flagpole to the bottom of the flagpole. And you can see that that's exactly where we ended up. Traded identically to the flag. It's just got a slightly different shape to it. It tends to be a little bit more explosive, only because it's not sideways consolidation. It's a constriction of price as opposed to just back and forth. So there does tend to be a little bit more explosive attitude with these pennants. Pennants are a little harder to draw out at times because they are not perfect like a flag is, or roughly perfect. So there is a little bit of debate here and there about them. But at the end of the day, like with all things, the most basic way to look at it is that there was a short-term trend line that got broken. But you use that pole to measure, think of it along those lines. You will find that pennants and flags both work rather similar as far as their reliability. A lot of people pay attention to them. They do tend to be self-fulfilling prophecies, probably because so many people know that the pole is the target. In the next video, we'll start putting everything together, throwing some chart patterns, Fibonacci, support, resistance, and volume, things like that together to lay out some potential setups and trades. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to take a look at putting some things together, basically Fibonacci support and resistance and some patterns that we've recently looked at to show you how you can get some confirmation on some of these setups. So in front of you, you'll see that I have the bearish pennant that was in the previous video, and certainly a sell signal once we break down below there. But the question then becomes, how do you look at it if you miss the trade? Where would you want to get back in? That type of thing. Or better yet, where would you want to take profit if you were already in this? Well, you can figure that out by clicking on the pitchfork menu and going to the fib extension, and simply, if you remember, you just drag it down there and then bring it back up to the entry point. And you'll notice that we went all the way down to the 1.618 level, and that is the first target on the extension. The wick of the candle really just kind of kissed that perfectly. So that's one way that you can use some of these Fibonacci tools to try to give yourself A, some more confirmation, and B, the opportunity to perhaps set a decent profit target. Another thing that you can do is you can use Fibonacci retracement. Again, had you missed that trade, you could look at it from the breakdown, and you can see that the 61.8% level offered a lot of resistance, and it did fall from there, so you could have profited some, or you can take the entirety of the move, which would be the more traditional way to do it. And you can see that the 38.2% level offered a selling opportunity, and so did the 61.8% level later. So certainly there are a couple different ways you could have used Fibonacci with that setup. So let's take a look at a symmetrical triangle in the Litecoin 4-hour chart. Now let's just say you missed the move, so what do you do with this? What do you just watch it go by, or do you look for the next potential setup? Well, luckily, since you have identified this as an area that has caused this shift in perception, if you will, you can click on the fib retracement from the move, go down to the bottom, and you can see clearly that the 61.8% Fibonacci retracement level has caused resistance. You could have sold and picked up a nice profit here at that point. So just another way that fibs can help even when you miss the initial move. So definitely something to keep in mind. And then finally, Ripple. Ripple 1-hour chart, we have a rounded bottom. It's a messy rounded bottom, but at the end of the day, it is clearly a reversal pattern. Again, I'll take the Fibonacci retracement tool. You can run it the entirety of the move, and you can see cleanly and clearly that the 50% Fibonacci retracement level has offered support. We've formed a double bottom, which creates its own trade, and this was previous resistance acting as support. So a good setup all the way around. You had several reasons to think that this area would hold, and it in fact did. You're going with the momentum. They kind of let it go a little bit, but that's normal. The exhaustion sets in. All of the sellers here are trying to get out down here so that they save most of their trading capital. People who missed the move, like yourself in this instance, are trying to join it down here, and you can see clearly that this is an area that would have been an excellent buying opportunity. In the next video, I'm going to put some more things together using chart patterns and technical indicators combined to show you the power of using all of those to complement your trading decisions in the cryptocurrency markets. Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. In this video, I'm going to start to put things together with chart patterns and technical indicators, showing you how this all can come together. In front of you, I have Ethereum 1-hour chart, and you can see that I have a symmetrical triangle. And the symmetrical triangle, remember, shows indecision in the marketplace. You want, hopefully, for it to break down before the end. Within the first 75% or so is technically perfect, but at an 80% break of the distance, certainly people will get involved. So you get this, and then the question is, do you believe it? Well, there's a couple different things you can look at here. Is volume picking up? And the answer is yes. So that's a good sign that the bearish pressure is going to continue as you break through the uptrend line. But notice I have the MACD underneath, and the MACD has crossed right at that level and then crossed the zero line. So depending on how you use the MACD, remember you can use it as a cross. You can use it as crossing the zero line. You can use it across an extremely overbought area. Or you can use it for divergence. There's a lot of different ways MACD is used. But in this scenario, you had at least two different reasons on MACD to think that this breakdown was going to happen. And then, of course, you had the volume pickup. So pretty powerful evidence of how these things can all tie together. Over here in Litecoin, I have a triangle drawn out as well, but I also have a couple of moving averages. Now, depending on how you use them, you might have been short of this pair back here, especially back here with the volume spike. But even if you weren't, and you saw this triangle form, since it's relatively symmetrical, you know that it's a 50-50 shot as to which direction it goes, but once it goes, people will follow. Notice how we're definitely in a downtrend. The quicker the 20 EMA is underneath the 50, and it's spreading nice and wide. So that shows conviction. So on the break of this, the increase in volume, the EMA is all moving in the right direction. You would have been much more comfortable shorting this market, sending Litecoin lower. You extrapolate the target price, no problems whatsoever. And over here in Ripple, I have a rising wedge, which of course is a technically bearish pattern. The question is, what could have helped you with this? Volume did pick up, but it wasn't insane. It wasn't like a huge amount of volume, but you got to cross right at the zero line and you started to fall in the MACD again. Yet another reason to think that this market would probably turn out the way you had hoped. On that trade, you take your target, you lay it out, perfect trade. MACD goes a little bit flat for a while, and then it does continue lower, but your setup has worked out. As you can see, there are a lot of different ways to use indicators with technical patterns. And I would also suggest that perhaps you could not only use that, but you could use, again, our Fibonacci tool, because it is so widely known and loved. This case here, you could have re-entered on the 61.8 like we had talked about previously. So really at this point, you would have had your target hit, you would have watched it fall, and then you would have said, okay, how do I re-enter? Well, you have a couple different things going on here. You have the rising wedge, which should now be resistance here horizontally. You have the 61.8% Fibonacci retracement level, and a candle or two later, you have the crossover in the MACD. Beyond that, I would also point out that the histogram was going lower, meaning momentum was running slower while price was rising. So you had divergence as well. A confluence of several different things to think that, hey, this market's probably going to fall. And, you know, the question that I get a lot is, how do I know which technical indicators to trust? And the simple answer is this. When you have several different indicators, patterns, volume, all kind of working in the same direction, you know that the general trading public is paying attention to some of these, all of these. You know, the next person may be paying attention to only two of them or whatever. But the more of these things that come together, the more likely it is that the crowd is all going to jump in one direction because they are getting the same signal regardless of what their system may be. So with that, I would implore you to take a look at indicators and chart patterns along with Fibonacci when it suits the purpose, and try to set up the best trades that you can take. Remember, it's about profiting. It's not about pressing buttons. It's about setting up the proper trades, taking the high probability trades to mitigate your risk. It's about money management. All of these things come together to make a profitable trader. Thank you for watching, and this concludes the chart patterns for cryptocurrency trading module. Thank you for taking Cryptocurrency Trading, How to Profit Daily with Technical Analysis by Wealthy Education. We hope you found this course informative and wish you good trading. Remember, if you have any questions, feel free to reach out to me or just simply post your question on the discussion forums.